What's up everyone, welcome back to another video with the Millennial Finance. Recently, Rakuten launched trading on the Hong Kong exchange. It almost feels like they knew something because Chinese stocks have been on a tear over the past few months. So I thought today, I'll talk about the Hong Kong market and whether it's worth us investing into Chinese stocks through it. Let's find out. Cha-ching! We're only 2 weeks into 2023, but as of the time that I'm recording this video, the Hang Seng Index is already up nearly 10% this year. If we zoom out just a bit more, then it's even more impressive because over the last 3 months, the Hang Seng Index is up by over 30%. This comes mainly from the fact that the Chinese government finally decided to lift COVID restrictions after what seems like forever. While the rest of the world moved on, China lagged and attempted a zero COVID policy, which probably didn't work like they wanted to. As we already know by now through experience, lockdowns are bad for the economy, and that is probably a big part of why Chinese stocks have performed so poorly in 2022. Now that they're open though, the economy will slowly start to recover, but as usual, the stock market will front run it, which is why Chinese stocks have been going up by so much. This makes it an opportune time for us to consider whether it's worth us investing into these stocks through the Hong Kong stock market. One thing that can be slightly confusing is what Chinese stocks have to do with the Hong Kong stock market when they already have their own. The thing is, retail foreign investors like ourselves cannot invest directly into the Chinese stock market like the Shanghai Exchange because that is exclusively for locals. To circumvent this, these companies will also have H-class shares, which basically means it's listed on the Hong Kong Stock Exchange, which is much more friendly to foreign investors. So should you consider investing into Hong Kong stocks? Well, there are a few considerations. I'll go through the pros and cons, starting with the pros, with the first one being the stock recovery in 2023. As mentioned earlier, the reopening of the Chinese economy will be a huge tailwind for the companies there. This is similar to what happened globally after we all started to slowly reopen our economies. Yes, in the US, there was an added boost of unlimited quantitative easing, aka the Fed was printing money like there was no tomorrow. We probably won't see this in China, which means we shouldn't expect that kind of move, but there is still potential for large gains. So I'm not saying that these companies will go on to do what the tech companies did in 2020 and 2021, because that will probably never happen again in our lifetimes, but we should see a gradual recovery at least to where they were before all of this happened. For example, stocks like Miniso are already up 176% since their lows in September of 2022. Many analysts are also starting to give overweight ratings on Chinese stocks, which essentially means that they're bullish. We know better than to blindly follow analyst calls, but they do have some good points, especially as this exact scenario has played out in the rest of the world. Many Chinese stocks are also extremely cheap on a valuation perspective, which makes me even want to consider investing into individual Chinese names. The second benefit of investing in the Hong Kong Stock Exchange is that you will get portfolio diversification. This is especially for those of you who have nearly your entire portfolio in the US, just like myself. This amount of concentration in just one country opens us up to risks just like what we saw in China over the last few years. Even though I've diversified my portfolio quite a bit, I believe that I'm still very heavily weighted towards US stocks. There's been a lot of debate going on social media right now on whether the US will continue to be dominant in terms of stock market performance, which is making me reconsider some of my investments and potentially shifting my portfolio balance more towards ex-US. I'm not going to make any rash decisions. I don't want to just, sort of follow the crowd. I'll be doing more research on this, but it's nice to finally have another high potential market out there because let's be honest, investing in countries like Japan and Europe just doesn't seem that interesting. So the final benefit of investing into Chinese stocks through the Hong Kong Stock Exchange is that they have many large companies with familiar names to most of us. Outside the US, they probably have the largest share of well-known companies that operate globally. Think of the names like Alibaba, Xiaomi, and AIA. These are companies that not just operate in Southeast Asia, but they also are household names. I didn't even know until recently that AIA was based in Hong Kong. I even bought insurance from them, but I was totally clueless. So after hearing some of these names, you might be thinking, why would we buy these stocks through the Hong Kong stock market when they're already listed on the US stock market and we can buy them easily. ADRs are definitely a viable option if you want exposure to the Chinese stock market, but there are some risks to it even though it's minimal. After all, ADRs kinda act as a loophole for Chinese companies to list in the US because technically they aren't allowed to. So now that we've talked about all the benefits of investing into Chinese stocks, let's move on to the cons, with the first one being geopolitical risk. No matter how attractive Chinese stocks look like on a valuation basis compared to their peers, they will always seem to trade at a discount, and that's partially because there will always be geopolitical risk assigned to it. We never know what new policies the government will introduce on a whim. For example, in 2021, the Chinese government all of a sudden decided to crack down on online education companies, which led to the stocks falling by up to 70% in just one day. Of course, these things can happen in any country. Any government can decide to change policies whenever they want, but China is definitely a bit more trigger happy when it comes to making these kinds of decisions. This was one of the reasons that I didn't want to invest into Chinese companies back then, because the risk reward just didn't make sense. In recent times though, they seem to be a lot more chill with this kind of stuff. They don't threaten big tech anymore, which is good. But the main reason that I'm looking at it now and it's more attractive is because the valuations are much better. Because of this geopolitical risk, I would only want to invest in Chinese companies if their valuations are a lot better than the ones in the US, because let's say they were trading at similar valuations, why would I want the added risk of China? Now though, this seems like a risk potentially worth taking. I have to have my China. However, this should be decided based on your risk appetite. It may not be for everyone. Like I said, Chinese online education companies dropped 70% in just one day. Can you stomach that kind of volatility? The other big con, in my opinion at least, is that there is a high barrier to entry when you trade through the Hong Kong stock market. This is because, similar to stocks that trade on Bursa Exchange, they trade in lots of 100 shares. This may not be a problem for those of you who already invest in the Malaysian market, but unlike the stocks on the Bursa Exchange, Chinese companies tend to trade at much higher prices. Now, just to reiterate, higher prices doesn't mean that the companies are worth more. It just means that the company decided that they want their share price to be a certain level. This is especially true for the high quality ones. So for example, let's say we want to buy Alibaba and we look at Alibaba stock on the Hong Kong Stock Exchange. If you want to invest into the company, the minimum amount you can buy is 100 shares. Each share is 112 Hong Kong dollars, which means your minimum investment is 11,200 Hong Kong dollars. This is equivalent to about 6,200 ringgit. So alternatively, you can instead invest in Alibaba's ADR that's listed in the US, with a current price of $15 or roughly 500 ringgit. This makes the barrier of entry significantly lower on the US stock market. So of course, not all Chinese companies are listed in the US. A big example of this is Tencent. They only list on the Hong Kong stock market, so if you want to invest in a company like that, then you will have to do it through the Hong Kong Stock Exchange. If you have a large portfolio and you're okay throwing 10,000 ringgit every single trade, then this shouldn't be an issue for you. But for those of you who are just starting to build out your portfolios, then the Hong Kong stock market may not be the most beginner-friendly option. Having said that, I'm still keen on trading some Hong Kong stocks through Rakuten. There are a few interesting names out there. I've been doing some Googling. I've been looking at Rakuten posting the top traded stocks, but I'd probably end up just investing into the names that I always do, like, Pinduoduo or JD. It's convenient that we can now trade, US, Malaysia, and Hong Kong stocks all from the same broker, and they also support you converting your currency to the Hong Kong dollar if that's your thing. If you want to find out how to convert your currencies on Rakuten and whether it makes sense, then check out this video. With a similar fee structure for Malaysia, US, and Hong Kong based stocks, then Rakuten is actually one of the better options out there if you want to invest your money globally. So let us know down in the comments below, would you invest in Chinese companies through the Hong Kong stock market? Thanks for watching this video to the end, guys. Give us a huge thumbs up and subscribe to the channel if you haven't already. See you guys in the next one. Peace out.